Hi, respective friends. Today we gon discuss on insight on the section 135 of the Companies Act 2013 deals with corporate social responsibility CSR. Topic in FAQ manner 1 by 1. Which companies are covered? Exemption given to the company if any and composition required. As per section 135, every company, including times private companies, times public companies, times listed companies, times holding or subsidiary companies, times foreign companies having branch project office in India must comply if it meets any one of the following criteria during the immediately preceding financial year. Criteria threshold net worth 500 crore rupees or more, turnover 1000 crore rupees or more, net profit 5 crore rupees or more, white right pointing back hand index even meeting one of these conditions triggers CSR applicability. Exemption. Specified IFSC public company and specified IFSC private company from commencement of business up till 5-year wide notification dated 4th January 2017. Various composition for the listed company Rule 5 CSR Committee. 1. Listed company -3. 3. Directors within at least 1. 1. Independent director. Section 149. 1. A. Minimum 3 directors plus Section 135. 1. Minus 1 independent director. 2. Unlisted company 3. 3. Directors of which one shall be independent director. Section 149. 1. A. Minimum 3 directors plus Section 135. 1. Minus 1 independent director. 3. Private limited 2. 2. Directors and independent director not required. Section 135. 1. Proviso 1. 4. Foreign company at least 2 person of which one shall be person as specified under Section 381 1 D of Companies Act 2013. 2. What do you mean by foreign companies and whether CSR applicable to foreign companies and when must a foreign company comply with CSR? As per Section 242 of the Act, a foreign company means a company incorporated outside India which has a place of business in India through times branch office times project office times liaison office times any other business presence in India and conducts business activity in India. So even though it is not incorporated in India, it becomes subject to CSR if conditions are met. Under Section 135 of the Companies Act 2013, CSR provisions also apply to certain foreign companies operating in India. A foreign company must comply with Section 135 if it meets any one of the following financial thresholds during the immediately preceding financial year. In India, business operations criteria threshold net worth 500 crore rupees or more, turnover 1000 crore rupees or more, net profit 5 crore rupees or more. 3. How is net profit calculated for foreign companies? Net profit is calculated as per times Section 198 of the Act and times profit arising out of business operations in India. Global profits of the foreign parent company are not considered. Important. For foreign companies, these figures are calculated only in respect of business operations in India, not global income. Section 381 accounts of foreign company read with Rule 4 financial statement of foreign company or shall prepare financial statement of its Indian business operation read with Rule 5 audit of accounts of foreign company. 4. What must the foreign company do if CSR applies? Answer. If the financial criteria are met, the foreign company must A. Constitute a CSR committee. CSR committee shall consist of times at least 2 persons times 1 person resident in India authorized to accept notices on behalf of the foreign company times another person nominated by the foreign company. No requirement of independent director. B. Spend 2% on CSR. It must spend at least 2% of the average net profits of the last 3 financial years from Indian operations on CSR activities in India. C. Reporting requirements. Foreign companies must times include CSR details in the balance sheet filed under Section 381 1b. Times file required documents with Registrar of Companies ROC. Times disclose CSR activities in prescribed format. 5. Where can foreign companies spend CSR? Answer. CSR must be spent in India on activities listed under Schedule 7 such as times education times, healthcare times, rural development times, environmental sustainability times, disaster relief times, women empowerment times, PM National Relief Fund. CSR spending outside India is not allowed. 6. What if CSR amount is not spent? Answer. If the required 2% amount is not spent, times unspent amount relating to ongoing projects transferred to unspent CSR account within 30 days. Times other unspent amount transferred to a specified fund within 6 months. Times penalties may apply for non-compliance. Practical example: suppose a US company opens a branch office in India. Indian branch financials times net profit year 1 6 crore rupees times year 2 7 crore rupees times year 3 5 crore rupees average net profit is equal to 6 crore rupees. CSR obligation is equal to 2% of 6 crore rupees is equal to 12 lakh rupees. The foreign company must spend 12 lakh rupees on CSR in India. Key points to remember: heavy checkmark applies only if thresholds are met. Heavy checkmark calculation based only on Indian operations. Heavy checkmark CSR must be spent in India. Heavy checkmark separate CSR committee required. Heavy checkmark reporting under Indian law mandatory. 7. Is a company required to disclose the composition of its corporate social responsibility CSR committee in the board's report? Answer. Yes. Pursuant to Section 134(3). O. Read with Section 135 of the Companies Act, 2013 and Rule 8 of the Companies Corporate Social Responsibility Policy, Rules, 2014. Every company required to constitute a corporate social responsibility CSR committee must disclose its composition in the board's report. As per Rule 8, times the board's report shall include an annual report on CSR. Times the format of the annual CSR report is prescribed in Annexure 2 to the CSR rules. Under Annexure 2, the disclosure must specifically include times the composition of the CSR committee times name of each director times designation category, example executive director, non-executive director, independent director, times number of meetings of the CSR committee held during the year times number of meetings attended by each member. 8. What are the statutory functions and responsibilities of the Corporate Social Responsibility CSR Committee? Answer. The functions of the CSR Committee are prescribed under Section 135(3) of the Companies Act, 2013. Read with the Companies Corporate Social Responsibility Policy, Rules, 2014. As per the Act, the CSR Committee shall perform the following key functions. 1. Formulate and recommend the CSR policy. The CSR Committee is required to formulate and recommend to the Board a Corporate Social Responsibility CSR policy. The CSR policy must times indicate the CSR activities to be undertaken by the company, times ensure that such activities fall within the areas or subjects specified under Schedule 7 of the Act. Schedule 7 includes activities such as times eradicating hunger, poverty and malnutrition, times promoting education and healthcare, times environmental sustainability, times gender equality and women empowerment, times rural development projects, times contributions to specified funds, etc. The committee plays a strategic role in identifying CSR focus areas aligned with the company's objectives and statutory requirements. 2. Recommend the amount of expenditure. The CSR committee must recommend to the board the amount of expenditure to be incurred on CSR activities. Under Section 135(5), the company is required to spend at least 2% of the average net profits of the 3 immediately preceding financial years on CSR activities. The committee times calculates the CSR obligation, times allocates funds project-wise, times recommends budget distribution between ongoing and other projects. The final approval of expenditure rests with the board. 3. Monitor the CSR policy. The CSR committee is responsible for monitoring the CSR policy of the company from time to time. Monitoring includes times reviewing implementation status of approved projects, times ensuring funds are utilized for approved purposes, times evaluating progress of ongoing projects, times ensuring compliance with statutory timelines, times reviewing impact assessment reports where applicable, This ensures accountability, transparency, and effective utilization of CSR funds. Practical significance of the CSR Committee's role. The CSR Committee acts as times a policy formulating body, times a recommending authority, times a supervisory and monitoring mechanism. While the board retains ultimate responsibility, the CSR Committee ensures structured governance and statutory compliance in CSR implementation. 9. What are the responsibilities of the Board of Directors in relation to approval, disclosure, and implementation of the CSR policy? Answer. The responsibilities of the Board of Directors with respect to corporate social responsibility (CSR) are prescribed under Section 135(4) of the Companies Act 2013. Read with Rule 9 of the Companies Corporate Social Responsibility Policy Rules 2014. The board of every company covered under Section 135 1. Must perform the following statutory duties. 1. Approval of the CSR policy. After considering the recommendations of the CSR committee, the board shall times approve the CSR policy of the company. The CSR policy must times indicate the CSR activities to be undertaken, as specified under Schedule 7 of the Act, times provide the guiding principles for selection, implementation, and monitoring of CSR projects, times include modalities of fund utilization and implementation schedule, as per amended CSR rules. The board cannot approve a CSR policy independently without considering the recommendations of the CSR committee. 2. Disclosure of CSR policy. In board's report, the board is required to times disclose the contents of the CSR policy in its board's report prepared under Section 134. This ensures transparency to shareholders and stakeholders regarding times the company's CSR objectives, times focus areas, times implementation framework. Additionally, the board's report must include an annual report on CSR in the format prescribed under Rule 8 and Annexure 2 of the CSR rules. 3. Placing CSR policy on company's website as per Rule 9. Times the board shall ensure that the CSR policy is displayed on the company's website, if any. The disclosure on the website should include times composition of the CSR committee, times CSR policy, times CSR projects approved by the board. This promotes public accessibility and corporate transparency. 4. Ensuring implementation of CSR activities. The board must ensure that times the activities included in the CSR policy are actually undertaken by the company. This means the board must times oversee execution of approved CSR projects, times ensure funds are utilized for approved activities, times ensure statutory spending obligations are met, times monitor compliance with timelines and reporting requirements. While the CSR committee recommends and monitors, ultimate responsibility lies with the board. 10. What is the statutory CSR spending requirement of a company and what are the consequences of non-compliance? Answer. The statutory obligation relating to corporate social responsibility (CSR) spending is prescribed under Section 135(5) of the Companies Act 2013. Read with the Companies Corporate Social Responsibility Policy Rules 2014. 1. Minimum CSR spending requirement, 2% obligation. The board of every company covered under Section 135 1. Shall ensure that the company spends at least 2% of the average net profits of the 3 immediately preceding financial years in pursuance of its CSR policy. In case of newly incorporated companies, if the company has not completed 3 financial years since incorporation, the 2% shall be calculated based on the average net profits of the immediately preceding financial years actually completed. The spending must be times in accordance with the approved CSR policy times on activities specified under Schedule 7 of the Act. 2. Preference to local area. The first proviso to Section 135(5) requires that the company shall give preference to the local area and areas around it where it operates. This does not make local spending mandatory but requires reasonable preference, especially where the company's operations impact surrounding communities. 3. Treatment of unspent CSR amount. If the company fails to spend the required CSR amount, the board must a. Disclose reasons, specify the reasons for not spending the amount in the board's report under section 134. 3. O. B. Transfer of unspent amount. The treatment depends on whether the amount relates to an ongoing project. I. If not related to an ongoing project, the unspent amount must be transferred to a fund specified in Schedule 7, such as PM National Relief Fund, Clean Ganga Fund, etc., within 6 months from the end of the financial year. 2. If related to an ongoing project, Section 135. 6. The unspent amount must be times transferred within 30 days from the end of the financial year times to a special bank account called the unspent CSR account, time spent within 3 financial years. If not spent within 3 years, it must then be transferred to a Schedule 7 fund within 30 days from completion of the third financial year. 4. Set-off of excess CSR expenditure as per the third proviso and applicable CSR rules. If a company spends more than the required 2% in a financial year, times the excess amount may be set off against CSR obligations of succeeding financial years times the set-off can be carried forward for up to 3 succeeding financial years times the board must pass a resolution approving such set-off. However, times surplus arising out of CSR activities cannot be treated as excess spend. Times surplus must be reinvested in CSR activities. 5. Meaning and calculation of net profit. As per the explanation to section 135, times net profit shall be calculated in accordance with section 198 of the Companies Act 2013. Times certain sums as prescribed under the CSR rules are excluded. Times it does not mean profit as per Income Tax Act or simple accounting profit. Section 198 provides a specific method for computation, including inclusion and exclusion of certain items such as capital profits, revaluation gains, etc. 6. Consequences of non-compliance failure to times spend the required amount, times transfer unspent amount within prescribed timelines, or times comply with CSR provisions may attract penalties under Section 135(7) of the Act on the Company and Officers in Default. Practical summary under Section 135, 5 times CSR spending of 2% is mandatory. Times mere disclosure of reasons is not sufficient after amendments. Times unspent amounts must be transferred as prescribed. Times excess spending may be carried forward subject to rules. Times net profit is calculated as per section 198. The ultimate responsibility for ensuring compliance rests with the board of directors. Here is a professionally drafted detailed FAQ with answer covering section 135, 6 and related CSR rules. Q.11. What is the statutory treatment of unspent CSR amount relating to ongoing projects? Answer. The treatment of unspent corporate social responsibility CSR amounts relating to ongoing projects is governed by Section 135, 6 of the Companies Act 2013. Read with the Companies Corporate Social Responsibility Policy Rules 2014. This provision applies where the company has failed to fully spend its CSR obligation under Section 135(5) and the unspent amount pertains to an ongoing project. 1. Meaning of ongoing project as per the CSR rules. An ongoing project means times a multi-year project undertaken by a company in fulfillment of its CSR obligation, times having timelines not exceeding 3 years, excluding the year of commencement. Times includes projects initially approved for 1 year but extended beyond 1 year by the board based on reasonable justification. The project must be undertaken in pursuance of the approved CSR policy. 2. Mandatory transfer to unspent CSR account. If CSR funds remain unspent at the end of the financial year and relate to an ongoing project, times the company must transfer the unspent amount times within 30 days from the end of the financial year times to a special bank account times opened in any scheduled bank times titled Unspent Corporate Social Responsibility Account. This transfer is mandatory and time-bound. 3. Utilization timeline. 3 financial years once transferred to the unspent CSR account. times the amount must be spent within 3 financial years from the date of transfer times the expenditure must be strictly in pursuance of the CSR policy times it must be used only for the ongoing project for which it was earmarked. This provision ensures that CSR commitments are eventually fulfilled rather than indefinitely deferred. 4. Failure to utilize within 3 years. If the company fails to spend the amount within 3 financial years, times the unspent amount must be transferred times within 30 days from completion of the third financial year. Times to a fund specified in Schedule 7 of the Act. Examples of Schedule 7 funds include government notified relief and development funds. After such transfer, the company cannot retain control over the amount. 5. Compliance and reporting requirements. The board must times disclose details of unspent CSR amount in the board's report under Section 134. 3. Times provide project-wise details in the annual CSR report. Annexure 2. Times ensure proper monitoring and documentation of utilization. Non-compliance with transfer timelines may attract penalties under Section 135(7). 6. Practical compliance flow. 1. Calculate CSR obligation 2%. 2. Identify amount unspent at year end. 3. Determine whether it relates to an ongoing project. 4. Transfer to unspent CSR account within 30 days. 5. Spend within 3 financial years. 6. If not spent, transfer to Schedule 7 fund within 30 days after third year. Summary under Section 135(6). Times unspent CSR relating to ongoing projects cannot be retained by the company. Times it must first be transferred to a designated unspent CSR account. Times it must be utilized within 3 financial years. Times failing utilization, it must be transferred to a Schedule 7 fund. The provision strengthens accountability and prevents indefinite parking of CSR funds. Times Secretaries. Here is a professionally drafted detailed FAQ with answer covering Section 135(7). Q.12 What are the penalties if a company fails to comply with CSR spending or transfer requirements under Section 135(5) and Section 135(6)? Answer. The penalties for non-compliance with corporate social responsibility (CSR) obligations are prescribed under Section 135(7) of the Companies Act, 2013. This provision applies where a company defaults in complying with times Section 135(5) minimum 2% CSR spending requirement and transfer of unspent amount other than ongoing projects to a Schedule 7 fund, or times Section 135(6) transfer of unspent amount relating to ongoing projects to the unspent CSR account and subsequent transfer to a Schedule 7 fund if not utilized within the prescribed time. 1. Penalty on the company. If the company is in default, it shall be liable to a penalty of twice the amount required to be transferred to times the fund specified in Schedule 7 or times the unspent corporate social responsibility account, or 1 crore rupees, whichever is less. Illustration. If the company failed to transfer 40 lakhs rupees, times twice the amount is equal to 80 lakhs rupees times maximum statutory cap is equal to 1 crore rupees times penalty payable is equal to 80 lakhs rupees. Since it is less than 1 crore rupees, if the defaulted amount is 70 lakhs rupees, times twice the amount is equal to 1.4 crore rupees times penalty capped at 1 crore rupees. Thus, penalty is equal to 1 crore rupees. 2. Penalty on officers in default. Every officer of the company who is in default shall be liable to a penalty of 1/10 of the amount required to be transferred or 2 lakhs rupees, whichever is less. Illustration. If defaulted amount is equal to 40 lakhs rupees, times 1/10 is equal to 4 lakhs rupees times maximum cap is equal to 2 lakhs rupees times officer penalty is equal to 2 lakhs rupees. Since lower amount applies, if defaulted amount is equal to 10 lakhs rupees, times 1/10 is equal to 1 lakh rupees times cap is equal to 2 lakhs rupees times officer penalty is equal to 1 lakh rupees. 3. Nature of liability. Times the penalty is civil in nature. Post 2020 amendment, CSR non-compliance is decriminalized. Times no imprisonment is prescribed. Times the penalty is monetary and adjudicated under the provisions of the Act. 4. When does default arise? Default may arise if the company fails to times spend the required 2% CSR amount, times transfer unspent amount, non-ongoing project, to a Schedule 7 fund within 6 months, times transfer unspent amount, ongoing project, to the unspent CSR account within 30 days, times transfer amount from unspent CSR account to Schedule 7 fund after 3 financial years. 5. Governance implications. The provision reinforces that times CSR spending is not merely a disclosure requirement but a statutory financial obligation. Times failure to transfer unspent amounts attracts automatic financial consequences. Times both the company and its officers are personally accountable. Summary under Section 135(7) of the Companies Act 2013. Times company penalty is equal to twice the untransferred amount or 1 crore rupees, whichever is less. Times officer penalty is equal to 1/10 of untransferred amount or 2 lakhs rupees, whichever is less. Times the liability arises upon failure to comply with Section 135(5) or 135(6). CSR compliance is therefore mandatory and enforceable through financial penalties. Penalties for non-compliance after amendments, notably 2019 and 2021 times unspent CSR amounts must be transferred as prescribed. Times monetary penalties can be imposed on the company or officers in default. There is no imprisonment now, only monetary penalty.